Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and thank you guys for joining in. We are going to talk about the active actions of passive investing. Even though you're passive in an investment, it doesn't mean you don't do anything, right? There is some active due diligence that you have to perform before you select a passive investment and select a sponsor to work with. And Ashley here, I can't think of anybody better but Ashley to come talk about this. One thing I love about Ashley, I'll just give you a little brief overview of how we met. And I've always heard a lot about Ashley from other people. Ashley this, Ashley that. Ashley is awesome. You need to meet Ashley. And finally, I met her May this year in a women's mastermind that our previous speaker, actually, Kathy Fetke, hosted in Malibu. Amazing setting. And Ashley was one of those people who really caught my eye because of two things. One is I talk a lot, right? Like I can go off into tangents. Ashley's like listening. And then she just delivers this one sentence. And I'm like, dang, girl, you summarized everything I could have said and so perfectly. And, she's just a very keen observer and she's just got a lot of clarity in when she speaks. So I really appreciated that. And of course, she's got a lot of experience in the multifamily world. So I wanted to bring her in to talk about how we could be better passive investors. I know I'm still learning every day that I think I know, I learn something new and you're like, oh yeah, I could do this better, right? So let's all have an opportunity here today to learn from Ashley. She's the co-founder of Bar Down Investments. And she also works with her partner, Jay Scott. I don't know if you guys have heard of Bigger Pockets. I think a lot of you guys must have heard of it. Ashley is very active with Bigger Pockets, and Jay Scott is also very active in Bigger Pockets. So both of them come from that Bigger Pockets world. I didn't know what Bigger Pockets was until people are like, you don't know what Bigger Pockets is? What world are you living in? So every investor in real estate is pretty much aware of Bigger Pockets. So what are we going to talk about today? We're going to learn about why diversification is important in our portfolios, learn about how we can find good investments, how to identify them. And although Ashley is an active investor, she still invests passively. And Ashley is going to talk about why. For those active investors out there who are investing in their own deals, why should you still look at other deals? And I do the same, right? I invest in other people's deals for a host of reasons. And I'm sure Ashley will cover a lot of that today. So before I hand this off to Ashley, I have a few slides to go through. So one of these this is educational purposes. We hope that you guys can learn from this presentation. I'm so sorry about that. I have an alarm to get this started. So we hope that you can learn from this presentation, and we're not trying to sell anything here. We just want you to learn. And if you have any specific things you're evaluating right now, definitely use this knowledge, but also consult your attorneys, your financial advisors, or CPAs for all legal, investment, and tax situations. This is simply for educational purposes. Housekeeping, please ignore the fact that you can't type questions in the chat box. We only have Q&A box today, so we're going to work with what we have. You guys will be automatically on mute. So if you have any questions, please put that in the Q&A box and I'll be monitoring that. If you have any issues with the audio visual, again, type it in the Q&A box for today and let me know ASAP. This webinar will be recorded. A whole bunch of people will email me and ask, is this going to be recorded? Yes, it will be recorded and sent out to everyone. And please add my email to keep it going to spam or promotions. Here's a little bit about Cherry Street. I don't want to get into into too much detail. I work primarily putting together passive investments. I also do a lot of webinars of these kinds every 2 weeks. covering investments, taxation, asset protection, estate planning. Have a whole bunch of webinars on YouTube. If this is your first webinar with me, you can go to YouTube and find the recording of everything else, and I'll share the link with you shortly. I also do high cash value insurance policies. It's called infinite banking, for those of you not familiar. So I have an investor group. You're welcome to join me here, Purely Passive. And this is a YouTube channel. Please subscribe. It will help me build this channel. I think I have 1,500 subscribers right now, and it's growing. So please subscribe, and that really gives me a lot of inputs. Please provide your feedback. I'd love to get more presentations your way that is useful for you. The short link is bit.ly, cherry-street, all lowercase. That's a short link to the YouTube channel. Upcoming webinars, we have Why Invest in Senior Living Now. I probably will be talking about this because I am I have worked on senior living opportunities, and I'm working on a few more right now this year. So I'll be talking about why invest in senior living. Again, it's an educational webinar. It's not related to a specific investment. I'm hoping to bring actually Ashley's partner, Jay Scott. He has some amazing insights into the economic changes that we're currently going through. So I want to bring him on, and he's going to talk about the current economic environment soon. Also up in the pipeline is investing into short-term rentals. I have a couple of amazing women who are in short-term rentals that I want to bring, and how you can get into the short-term rental business. I think that'll be really cool. So if you have any questions or you have any topic suggestions, feel free to reach out to me. We usually do this every 2 Thursdays of each month, every other Thursday. So please let me know if you have any topic suggestions for me. Just a little bit about me. I moved here from Bangalore, India in '98, have a tech background, spent 20 years in technology, and moved into real estate since '09. Real estate really helped me free myself financially, and I transitioned to full-time real estate in 2019. Started with single family, moved into multifamily, and I actually am setting up an ATM fund right now. So I have a whole bunch of different assets with amazing people like Ashley, partners that I work with, including land, and also have a new ATM fund open that just opened up 2 days ago. So we are I'm trying to diversify outside of real estate a little bit right now, because the market in real estate is really uncertain. There is a lot of uncertainty, and it's pretty tight, and lending requirements are constantly changing. So I'm also always looking for alternative assets for my investors. So here is a little background here. I couldn't introduce Ashley without saying what an amazing person she is, not just from an investor standpoint, but Ashley actually competes in horse tournaments. I don't know what to call it. I'm sorry. She's an equestrian. What's the right word for it?
Jumping show.
Shows. Okay. She competes in shows. So she's just not an investor. And that's what I love so much about her, is that she's everywhere, and she does a lot of things well, right? It's very admirable that, she not only holds down 1,500 doors in multifamily, but also finds time to pursue her passions. So really kudos for that one. And she's a very inspiring person to me, one of the few people that I really look up to in the real estate world. So I'm so excited to have Ashley on today. She's a co-founder of Bar Down LLC, House It Look LLC, co-host of Passive Investing Show, and best-selling author of The Only Woman in the Room. If you're a woman and you're listening today, you know how hard it is to break into real estate, especially on the investing side, because we get very stereotyped into, hey, are you in real estate? Oh, you must be a realtor, right? So it's just not a lot of women break it out and actually make it big in the real estate investing world. And Ashley is one of the few. So I'm really blessed to have her on the show today. She started investing in '09 and has been involved in over $100 million in transactions across 1,500 units. And when she's not working on businesses, she's, of course, spending time with her family, but also competing with her horses, which is awesome. So with that intro, I'm going to hand it to Ashley and let her take it away. Thank you, Ashley, for being here. I'm really excited to have you and see what you have to share with the audience today.
Thank you so much, Kavitha, for having me. And thank you everyone for making time tonight. I know it's really hard to make time to listen to these webinars, but I can tell you that it will fast track your progress. I wish I had these webinars when I first got started. As Kavitha mentioned earlier, I started out through Bigger Pockets, just absorbing all of their podcasts and their content online. But there were very few resources outside of Bigger Pockets where you could get information about investing, whether it be active or passive. And I am very grateful. I'm tied to Bigger Pockets, and I'm, someone who loves to give back to that community because it had such an impact on me. Today, there are so many different opportunities to get information. For example, webinars like tonight, podcasts, YouTube videos, social media accounts. Really, there's just a plethora of content that you can absorb, and it really comes down to you on how much you want to take that information and act on it. So to start, I wanted to talk first about just active versus passive investing before we dive into diversification. So I'm sure we have people on tonight that range in experience from people who are probably starting to look into real estate or another asset class in which to invest, all the way to people who probably have quite a few investments under their belt and they're exploring other asset classes, which I'm going to talk about a little bit further into tonight's conversation. So to start with, there are two categories in which you can pursue investing. So you can either pursue from an active side or you can pursue from a passive side. The most simplistic way to think about it, let's use the example of flipping houses in real estate. If you are active in flipping houses, you were the one physically doing the work. You might find the property, you might come up with a scope of work, meet contractors, and then execute on that plan. If you are passive in that investment, perhaps you are the person who is providing the capital for someone to actively pursue that asset class. So let's say, for example, you are considered a private money lender or a hard money lender, in which case you will trade off your equity or your capital for that individual to then pay some sort of fee to use that capital. That is a very common way that a lot of people get started on a smaller scale in real estate, is by having some sort of capital investment in a smaller project. As you progress along your career and you have more capital at which you can deploy, or alternatively, maybe you have the capital already to deploy, but you are hesitant, you want to kind of test the waters, you look for other investments in which you can place a larger amount of capital, but you do so for other reasons. So notice that when I gave the example on the flipping houses analogy, I spoke about the return that you would get in terms of, the active investor paying maybe a fee and then also interest to borrow that capital. When you get into larger projects and different types of projects, different asset classes, you can also tap into tax benefits. That is a very, very common reason in which people passively invest. They're looking to offset their tax exposure. Now, I want to give the disclaimer that I am not a CPA. I don't try to pretend to be a CPA. So you should consult with your CPA before taking any action. The next thing I'll say is that you should have a CPA that specializes in real estate and tax advantage strategies. I can tell you that personally, I meet with my CPA, who is real estate focused CPA, and I meet with him once a year to figure out how I can defer all of my federal taxes. And I do that so that I then have more money to invest with. So I like to say that the wealthy aren't making more money. The wealthy are wealthy because they invest more money. And the reason they are able to do so is because they invest in asset classes that provide tax favored deferral type programs, so if it's through a 1031 exchange, if you've heard of that, opportunity zones, or they're investing in an asset class in which they can have a cost segregation, which is essentially a paper loss on your investment. There are recaptures, so there are other caveats that you have to take into consideration. But as my husband likes to say, the strategy in life is defer, 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 die. So ultimately, you do not have the tax exposure ever. The only catch is you have to continue to invest. So in terms of the different asset classes and looking for diversification, there are a lot of reasons that people should diversify. And the reason why it is so important to diversify is exactly what Kavitha just mentioned 5 minutes ago, which is the reason she's looking outside of just real estate. And this is a very common strategy for very sophisticated, savvy investors. They recognize that market cycles hit different asset classes in different ways. There are different impacts on those asset classes. One thing Kavitha just noted was the real estate is being impacted by the debt environment, the lending environment. That environment is honestly wreaking havoc on the ability to purchase properties and do new acquisitions. So there's a lot of idle money that otherwise would have been placed in multifamily real estate that now does not have a home. So looking for other asset classes where that capital can be placed is very important because time is money. And especially while we're in a high inflationary market, you have to have your capital working for you at all times. Any savvy investor will tell you that. I always say, when we're talking to different investors, when we talk to different investors and get investors to invest with us, if someone says, oh, I have $1 million to invest with you, that $1 million isn't sitting in a bank. It is deployed somewhere that they need time. That individual needs time to move around the allocation to then be able to invest because the money always needs to be put to work. And that's something that I did not know when I was younger. I wish I had known that strategy when I was younger. If I had known that when I was younger, because one of the really cool things is this whole compounding effect that happens. The earlier you start, the easier it is to grow your wealth. It's kind of like pushing a rock up the hill. And as soon as you get to the top of the hill and you crest the hill and there's a little bit of a dip down, even if you have a little hill after that, that rock has the momentum to go over that hill. That's exactly what it is for investing. So it's really important that if you're looking to invest passively, and you want to kind of build up that nest egg, be very disciplined about doing so. I can tell you personally, when I graduated from my master's, I had $38,000 in debt. Now, I'm sure this is a sore topic right now with the whole student loan forgiveness, and this is not meant to be a political statement, but I sacrificed for a year by having peanut butter and jelly sandwiches that I brought to work every single day and a recyclable little container of water that I brought. I didn't stop at the 7-Eleven or Wawa to get my lunch. I just went to work, I packed my lunch, and I came home, and I was able to pay off that $38,000 in 1 year. So I did not, spend a lot of money on other things. I stayed very disciplined and made sure that I got out of debt. And that's kind of the same thing you have to do when you're sacrificing to build up your nest egg to be able to invest. But I can tell you that it is worth it. It is just a little blip in your whole journey of being able to sacrifice and be disciplined to get started. And the hardest part is getting started. Once you get started, it becomes easier and easier and easier. So circling back to diversification. Diversification is important. Obviously, what I spoke about earlier in different markets, cycles. One thing that I did not know until just, I think about 2.5 years ago, I never knew that our country didn't operate under the same market cycle, coupled with the fact that asset classes didn't operate under the same market cycle. So what do I mean? About 2.5 years ago, everyone was talking about we were on the verge of a recession. And they were saying that across the country, we were on the verge of a recession. Well, that may be from a macro point of view, but when you looked at it from a micro point of view, especially when you looked at multifamily in Houston, Texas, and Little Rock, Arkansas, they were actually coming out of a recession and they were on the verge of coming out of recovery. So in terms of the 4 market cycles, they were about to be on the upswing. And, everywhere on the media, everywhere that, all the multifamily news reports, real estate in general, everyone was saying we were on the verge of a recession. Was it going to look like 2008? But here, if you really dug into the details and the research, you found these 2 pocket markets that were poised to be on the upswing. Now, we all know what happened with COVID, and that put the entire country in kind of a tailspin, and it reset all of the market cycles. So it was definitely an abnormality due to the pandemic. But what was the key takeaway there is that not every market nor every asset class is on the same market cycle trajectory. So it's really important for that reason to know where a market is within the market cycle, as well as the asset class that you're looking to invest. The second reason that it's really important to diversify is due to the team itself who are looking to execute on the investment. Everyone knows me in multifamily because I specialize in asset and construction management. That is my bread and butter. That is what I pride myself in. That's what I spend all of my time focusing on, is making sure that we not only operate a property well, but we operate it to the maximum efficiency and the best return for our investors. But what happens if I get hit by a bus? What happens if the systems aren't in place to carry forward when I'm not there? There are a lot of things that I have in place, and I have my team, on autopilot, but there are a lot of things that are situational dependent. There are so many moving parts to investments. They are a living and breathing organism in a sense, because they do not happen in a silo. They do not happen without being impacted by external factors. What would have happened if I was taken out for some reason? I got really sick or some other reason, and all of a sudden we had all of these assets going through COVID with my team, and I wasn't there to provide support. I thoroughly trust my team. I'm not trying to, undermine my team here, but I'm saying that if you were investing because of one single person, as opposed to an entire team, that could be a huge detriment, especially if that individual wakes up one day and decides, you know what, I'm done. I don't want to continue in this asset class anymore. I'm going to take a sabbatical. Whatever the case may be, it's really important to diversify. It's also important to diversify. I talked about the different market cycles, etc., but it's also important to diversify because of the market specifics outside of the market cycle. So what do I mean there? I mean policy, businesses, just news and changes of regulations within that market. So let's say, for example, that a market shifts and goes from being landlord friendly to tenant friendly, if we're going to use multifamily as an example. Or let's say, for example, that one of the biggest employers is going to pack up shop and relocate to Austin, Texas, which a lot of businesses are doing right now. But you were investing in California, let's say, and they decided, okay, we're going to move our plant to Austin, Texas. Well, how does that impact your investment? So there's a lot of reasons that you should be diversified from the market standpoint because things change all the time and you want to create balance. The last thing I would say about diversification comes down to more of an investing type of concept, which is, are you a wealth building individual or you investing due to capital preservation? Those are two completely different strategies. If you are in a wealth building mindset is someone who is going to invest in something that might have more risk associated with it, but in turn has more upside. If you are in capital preservation, you're someone who likes mailbox money. You like the consistent checks on a monthly basis. You're not as concerned about the huge upside because you like the reliable income that comes in. I actually invest in both. And that speaks to my desire to be highly diversified. We are invested in so many different things. To be honest with you, I don't even know every investment that we are invested in because one of my husband's, responsibilities for our family dynamic is that he looks for all of these alternative investments. So we are invested in different funds. Some of those funds are with notes. Some of those funds are in Bitcoin and blockchain. We're invested in other multifamily syndications that we are not leading. We are invested in precious metals. Like I said, I'm going to forget all of the things that we are invested in, but we are highly diversified. And the reason being is to get on all of the points that I just talked about. So that is really, really important to be extremely diversified because when you have little changes or major changes to the market, the strategy of being diversified is that all of your investments will balance each other out. It's kind of like how people historically invested with both stocks and bonds. So bonds were the more consistent, reliable, not as high of a return, but it was more reliable investment where stocks had more risk, but more upside. And by investing in both, there are certain times in the market where stocks are going to do better and certain times where bonds will do better, but ultimately they should help balance each other out and provide stability in your investing and your financial planning.
I just want to add something here,
go ahead.
Ashley, because 2020, actually, I'm the same way as you guys. I have been investing not only in multifamily, but ATM machines, energy investments, because they give active income tax breaks. And I was a W-2 at some point, so I was using that for active income tax breaks. For those of you who don't know, when you invest in oil and energy investments, you actually get active losses that you can offset W-2 income with, right? So I invested in that. I invested in Bitcoin mining funds because the miners actually are 100% depreciation. So I was trying to collect depreciation. So what was interesting that I noticed when 2020 happened is a lot of multifamily operators stopped paying distributions because they started withholding. Because we were in an uncertain environment and we didn't know what was happening next, right? Like, hey, maybe tenants will stop paying. Let's proactively stop the distributions. There were only 2 funds that were still paying me. And I mean, I had just started my business a year ago. So I'm like, okay, I guess this is when the diversification lesson really hit home for me, was that these 2 investments paid consistently. And one of them was ATM, actually. Like clockwork, it hit my bank account, right? So I was really grateful for diversifying back then. So anyway, I just wanted to share that story. I said 100% agree with you on this.
I completely agree. And the fund that paid during COVID, when things at the beginning were shutting down and people stopped doing distribution, for me, the fund that paid was actually a note fund that we were in, and that paid like clockwork. That I'll just give a plug. I'm not part of the company, but PPR Note Fund, which is founded by Dave Van Horn. He's also a bigger pockets guy too. He wrote the book on note investing. He started his company in 2006. So he even went through the real estate crash of 2008 and still paid out monthly. He has never missed a distribution.
I'm gonna look at that.
Yeah, so he has a couple different fund options. I know that's not what this is about, and you can buy individual notes, I think, from him still. But we invest a lot with him, and in several different funds for that mere fact. And another thing is, speaking of Dave's fund, I'm just going to give an example with Dave's fund, is that those funds we invest in different funds that he offers. Some of them, it's a 90-day call, and other ones it's a 3-year, commitment. He has a couple different options, but that's another way in which you can diversify. I see here, there's a question. Someone else is, endorsing PPR as well. They're incredible. But someone asked, if you're too diversified, how do you do your due diligence, et cetera? How do you stay on top of the changes of all these asset classes? So I'll answer the latter in just a second. But the one thing I have to say is, when you have these different funds that you're in with different access to getting your cash back, that's another reason to be diversified, because, with multifamily, you're kind of locked in for typically 3 to 5 years on average, depending on the strategy. It could be longer, it could be less, but there's really no guarantee, because if someone can't sell, if it's not the most opportunistic time to sell the property, then the operators, the active investors, the general partners are going to make a decision not to sell. And you, as a passive investor, don't get to decide when the property sells and you get your money back. So that is something that, with fund options, that's something that was very appealing to us as we look to, place capital for short-term type of gains. Now, of course, we're not going to get the same returns if we lock it in for a longer period of time. We knew that, but the ability to access the cash on demand with a 90-day call, was very favorable to us. As you know, as a multifamily, to have 90 days, that's typically, close enough to when you're closing. So, if you needed extra money to put in at the end, that seemed to be a good place to store it, so to speak, at a higher than comparative to a savings. So just circling back to the question that was in the Q&A on how do we stay on top of everything, that is a great question. And I can tell you, this might not be the answer you want to hear, but I'm just going to tell you the truth. My husband and I are both full-time real estate investors. That's what we do, full-time, all the time. We don't have regular working hours because it's 7 days a week. As Kavitha knows, once you're in it full-time, you're in it full-time. Holidays, weekends, it doesn't matter, you're in it. My husband does this full time, is to, not only does he help out on our multifamily business, for our underwriting, but he also vets every passive investment opportunity that comes across our desk. And he also seeks them out. So he probably, on average, I would say, listens to about 2 to 3 hours of podcasts a day. And he listens to them on double speed. So it's probably equivalent to, 4 to 6 hours a day, that he is gaining knowledge through all different podcasts, and he listens to books on tape, YouTube, etc. He listens while he works out, and he works out for 2 hours a day. So that's how I know for sure that that's how much he's listening to podcasts. From there, in terms of vetting, when he hears something that is of interest, then he explores it further. He researches it further. He does his own research. He looks into the individual that may have been interviewed on a podcast, or he looks into other individuals who are in that same space and making offerings. He also too talks within our network. So Jay, as Kavitha mentioned, Jay Scott is my partner. Jay and I, when we first started working together in multifamily, we would talk about different investment opportunities, et cetera. And we would kind of show each other, oh, we just got this looks interesting. What do you think? And we would help vet each other's ideas, which honestly is the way we came up with the idea for our podcast, the Passive Investing Show. We honestly talk about all of these different passive investment opportunities, and everyone was saying people would probably want to hear what you guys are talking about. Now that's not exactly how the show is formatted. It's really highlighting other individuals who talk about investment offerings they have. In fact, Kavitha, with the ATM, you should definitely, I'd love to have you on to talk about that. We haven't covered that topic yet. It would be amazing for you to be on the show. But this is something that we bring to people's attention where they can explore other passive investment opportunities that we highlight on the show. So we just thought, this is a great opportunity for us to vet these different asset classes and figure out which one is the best for us. When you're working a W-2, when you have another job that you're, highly focused on, it is very challenging to find time. So I'm going to give some tips because when I started in real estate, I was working in pharmaceuticals. I worked in clinical research and development for 3 of the top pharmaceutical companies in the world. I worked for Sanofi Aventis, GlaxoSmithKline, and Wyeth, which later got acquired by Pfizer. And I actually worked in global vaccine development as the director of global project management. So I know that when you are working at a high level, when you finally have the capital that you can deploy, you don't have the time because normally your job is taking you away from the availability you have to research all these different things. So here are some suggestions I have. First and foremost is make time like tonight where you prioritize attending events like tonight, and try to network and ask questions, follow up with the speakers, connect with the speakers. Most of the time, speakers produce content, and that provides additional opportunities that you can learn and research. And a lot of people stick together who have, Kavitha and I, we stuck together. Kathy Fettke, we're all part of the same kind of core group, and birds of a feather flock together kind of thing. So just recognize who's kind of hanging out with whom, and you can start to pick all the brains of that group until you find an asset class that speaks to you, because there are so many different asset classes and it's kind of a whirlwind at first. And the reason why it's a whirlwind is because you can be successful at any of them. You really can. The hardest part is staying focused and picking one and being dedicated to one. So unfortunately, I don't know who asked the question. It was submitted anonymously, but don't be overwhelmed by all the different asset classes. Just really try to focus on one that speaks to you, really dive in, learn that asset class. There's a saying, I know it's not just in real estate, but it's a no until it's a hell yes. That's the kind of scrutiny you want to do when you're doing your due diligence on the asset class. And then as you start to look into markets and operators, you want to do it under high scrutinization, because ultimately this is your money. This might be your retirement fund. It might be your kids' college education. It is very important that you do the due diligence up front so you don't get in a situation down the road that turns you off from investing altogether. Because if it does, most of the time, not all of the time, but most of the time, whatever you identify later on are things you could have identified up front if you had just spent a little more time doing due diligence. So it's really, really important that when you think, I want to be a passive investor, invest all of these different asset classes, you don't forget that passive investing actually involves active work before you can actually passively invest. Okay, so if we want to talk about switching topics to learning about how to find good opportunities, I personally think that finding good opportunities boils down to 3 components. Every situation has 3 components. The first component is the asset class in itself. So whether you want to invest in ATM, self-storage, multifamily, triple net lease, really any asset you can possibly think of, that is the first component that you're looking at. And as I mentioned before, you want to go into an asset class that really speaks to you. Kavitha mentioned oil and gas has, and I'm going to say it incorrectly, but ultimately has the ability for tax write-offs against W-2 income. I believe it's isn't it the only asset class? Is it the only asset class?
I think energy in general is the only asset class. So if you invest in solar energy or anything which related to energy, you can have an active tax break, active income tax break.
And I think like carbon credits too. We just had on someone, we just filmed yesterday a show, and we had a gentleman on talking about carbon credits, and that also applies within that sector because he was talking about the W-2 offset.
Yeah, and it doesn't have to just be the regular oil. Like what I'm invested actually is an interesting one. It's a pharmaceutical grade oil. So they use this sells at a much higher dollar amount per barrel. And it's used to make in pharmaceutical uses. Like for example, ultrasound gels, they use this oil. So it's just one of those things which is like different. And I liked the plan, one, because it was 100% depreciation. I had active income. I mean, like, hey, if you're saving 30% in taxes, that $30,000 you made right from the get-go. And I'm like, yeah, I'm all in, tell me more. And I knew the operator, he was reliable. I had worked with him on another deal. So there was this like trust factor, right? And I said, hey, why not? I'm going to try it. And one of the things I think is as you have more money in circulation, you become open to taking more risks, right? But when you're starting small and when you're starting, early, I think you just are like more capital preservation and less risks, right? As you kind of grow, you just have more play money, I mean, not that you're not careful with that money, it's just that you're willing to take a little more risk, right?
I completely agree. I also think too, it's heavily contingent on where you are in your personal life. So if you're later on in life, people tend to be a little bit more guarded with their money, right, because they're either thinking about the fact that it needs to carry them through the rest of life, or alternatively, it's going to be handed down in some sort of inheritance. So people are less risky at that time in their life. I think, you and I don't want to speak out of turn here, but where we are in our lives, we are able to take more risks. We have the ability to rebound if we lose, some money here or there. And not saying someone else doesn't later on, but maybe they just don't want to, like no one really wants, no one wants to, but yeah, so going back, to finding good opportunities, the second thing after you've identified the asset class that you want to pursue is the market in which it operates. So that doesn't necessarily need to be a geographical market. It could be the marketplace in which it operates, but it's the overall business in which that asset class is able to transact. So when you're looking at real estate, you're talking about like the physical market, but as Kavitha just mentioned with respect to oil, it's not necessarily the physical location of where that oil is being extracted. It could be the market, the trading market that's going on in pharmaceuticals. What is the demand? What is the supply? What is the and I actually haven't looked into this, so I'm just like spitballing here, but in terms of like, what is the chain supply issue that is going on with this? What is the breakdown in terms of producing it? So, obviously the oil is the raw material, but then it actually has to be a finished product. What does that look like? Are there shortages of any other supplies that get that oil to the finished product of the ultrasound gel? Ultimately, you have to kind of look at the soup to nuts of that entire operation to make sure that you're on board with the business plan as it operates within a given market. And then the third component, when you're looking for good opportunities, and to be honest with you, I think it's the most important, is the team. The team is the most important regardless of the asset class you pick, because the team can take a mediocre deal and make it a home run. And the team can also take a home run deal and be a mediocre team and the deal completely fail. The team is the most important component, and I can't stress that enough. Notice how I didn't bring up the returns. The returns are important. The returns are important in terms of, you know, as I mentioned before, whether you're wealth building or capital preservation, or if you're investing due to tax benefits, which is really the three reasons why someone would invest. But honestly, the team is going to be able to kind of give that stamp of approval that this has a high likelihood of being achieved versus this has a low likelihood. How do you identify whether or not you're working with a good team or not? Besides looking for references, which references are a really good place to start, someone who's either invested with them previously, that's a good way to start. But there are other ways in which you can look for, you know, to vet the team. So I like to think that most businesses break down due to lack of communication. I don't know the statistic exactly, but I remember that it's around 90% of companies fail due to communication breakdown. So that to me is something that is number one when I'm looking at an investment and understanding the team. Have they worked together before? Have they worked together in that capacity before? Meaning that in terms of the different roles that each other are playing, have they worked together in the capacity in which the business plan is to be executed? So what do I mean by that? Okay, let's take, for example, real estate, because honestly, it's the thing I'm most familiar with. So it's the easiest for me to come up with an example. If you're investing with a team that is doing A-class core plus assets, so we're looking at brand new construction, you know, anything, let's say from 2020 to 2022, and they're in A-class markets, and you know, this operator works with the property management company, and that's what their bread and butter is doing. And then all of a sudden they want to make a pivot, and now they want to work on distressed assets. It's not saying that if they shift to distressed assets that they will not have success. It's talking about probability of success. So if you have a team that works on A-class and all of a sudden they're going to shift and they're going to work on distressed assets, and they don't have a single team member who has ever worked on distressed assets, and even older vintage. So let's say, for example, now we're looking at 1980s vintage versus before they're at 2020 to 2022, and you don't have anyone on the team who's worked in that capacity. Does someone know how to look at, what's it called? I'm blanking on it, but just utilities, like utilities alone, they are completely different. The building codes were different, building materials, the way in which construction was constructed in the 80s versus 2020 is completely different. So do they have the wherewithal? Do they have that knowledge? Do they have the ability to execute in terms of the tenant base? The tenant base is completely different. It's completely different to be working in an apartment where a 1-bedroom, 800 square foot apartment is $3,000 a month to a 1-bedroom that's, let's say it's even the same square footage, 800 square feet, and they're charging $750 for the unit. There's difference in terms of operations. On the A-class, you might be charging an amenity fee to all the tenants that live there. If they tried to implement an amenity fee on a 1980s property that was a 1-bedroom charging $700 for an 800 square foot unit, no one would live there. So, you know, you have to understand the business operations of the different type of asset class demands. So understanding the team's experience and who is working on the team. Have they worked together before? Have they done that asset before? Have they led construction before? These are all things that are puzzle pieces to help you decide the probability of achieving the returns that they are projecting. So those, in summary, are the three things I would recommend that you look for when you are looking to invest. I'm so sorry. I'm like looking at the questions at the same time. So Kavitha has the one. Okay. So there's a question here. What are your strategies to bounce back from bad investments? How do you assess if it is an issue with the asset class, timing, or team? Have you ever doubled down after a bad investment? Okay, great. Really, really good questions here. So for any investment, whether active or passive, I do a debrief. I do a debrief with my husband, and I actually do this at different parts of the investment. So it's not even just more so for active investing, I should say, not necessarily passive investing, but for active investing, what we do is after we get something under contract, is there something we could have done better? Should we put a different policy in place? Are we streamlined in terms of the execution? Do we have any roadblocks in terms of how our company is organized in taking down a property? Due diligence, the same thing. Do we have all the tools? Do we do it efficiently? Our due diligence on, we can do a up to, I would say, probably 500 units in a week or less due diligence. Normally we can do it in around 3 days. We have the teams, the support teams to do it. And we're pretty thorough. We have a huge support system, but can we do it better? Can we do it, just because we can do it fast doesn't mean we're doing it the best. And even if we are doing it the best, there's always better. So looking at ways that you can improve constantly, we measure everything. So that's something that's really important. But going back to your question in terms of strategies to bounce back from bad investments, whether you have a good investment or a bad investment, you should always have a learned lesson. And taking those learned lessons only just decreases your chance of making that same mistake again. So I have made a lot of mistakes. I will be the first person to say that I've made a lot of mistakes. I've chosen the wrong partners before. I have not known what I didn't even know. So in terms of going into multifamily, there were assumptions I had that were completely inaccurate. And there are things that I've had to learn the hard way, and I've had to learn to overcome them and rebalance, the situation out. So for example, I came onto a situation where I was not part of the planning on the construction budget, but then I came in and said, oh, I can execute this. That was my flaw because I did not know the scope of the actual renovation that was needed. That's something today that if someone asked me to come on and lead construction management, I would want to firsthand go to the property, see the, not just pictures and word of mouth and someone else's report. I would physically want to go to the property and confirm that everything was captured correctly. And then I could put my stamp of approval saying that I could do this. I can execute on this level. So I think what's important is not necessarily getting down that you're going to make a bad decision or you're going to make a mistake, because you are. That's the nature of life. You're going to make mistakes constantly. And what's important is learning from those mistakes and putting in safeguards to prevent you from making those mistakes in the future. So I have never doubled down to ignore when I've made a mistake. I have never doubled down to say, well, I'm just going to carry through this bad investment and, we're just going to suffer. I have always, in fact, if anything goes wrong, I go into overdrive and want to outperform my original performer despite all the challenges that we faced. Because to me, I just think there's always a way to do something. I think there's always a way to do it better, always a way to come out ahead. So much so that I'm involved in a passive investment. I'm still involved in this one deal. And something happened on this apartment community, and I noticed that the operator was not doing what I think should have been done. So this speaks to, just because I'm a passive investor doesn't mean I'm going to sit on the sidelines. Passive investors, you do, but to an extent. So because I'm very familiar with construction, there was a situation in this investment that needed major construction overhaul, and I just saw things that weren't being executed on. So I offered and volunteered my time and support to help get that investment on track for free. I did not care to get part of the general partner equity. I cared about the fact that I had already invested passively in this deal, and it was important to me to safeguard my investment. Now, a lot of people can't do that. I know that they can't do that because they have other W-2 income, or they have too many other investments. But to me, it was very important. Unfortunately, that operator did not want to take me up on my offer, but I did give advice over the phone on multiple things that they could be doing. They took some of that advice. I don't know if it was because of that advice things turned around, or if it was other things. That's not the important part. The important part was things got turned around. So that is a particular situation in which it wasn't necessarily the worst investment. It wasn't the best investment, but it was a bad investment. And the person I am is not someone who's just going to sit there. Kavitha, I'm sure, can say that she is not surprised by this, that I'm just not going to sit there and say, okay, I'm just going to watch, my investment go up in flames, because that's just not me. So, okay. Next question. I may have missed it, mentioned earlier, but what method or app do you use to track your passive investments? Do you track the sponsor's cash flow, payments being timely, what return is promoted, tracking K1s received, and final overall actual returns after exit? I do not use an app. I use Google Sheets. Even our business, Bar Down Investments, we use Google Sheets for all of our tracking. We have a portal, and most investments that I invest in have a portal that you can access all of this information per investment. But in terms of a central repository, we use Google Sheets to track our individual investments. Pros and cons of investing in real estate in self-directed IRA vehicle versus directly. Okay, so first and foremost, I do not, I'm not a CPA, so I can't tell you for your personal situation whether or not it would be good to invest with a self-directed IRA vehicle or not. What I can tell you is I advise you to speak with your real estate focused CPA to advise you. I can tell you that with self-directed IRA, you are subject to UBIT, which is unrelated business income tax. And I was talking to a partner of mine today that UBIT gets a very bad rap, but sometimes it actually is not as bad when you project out the numbers than if you were to your alternatives. It might be worth it, but that's on a case-by-case basis. I'm not endorsing it at all. We have individuals that invest with us, both self-directed IRA and traditionally through directly through cash means. I would say with respect to our investors across our entire portfolio, about 25% of our investors invest with their self-directed IRA. So I don't know if that's industry standard or not. I can't tell you. I don't have those statistics, but I can tell you personally that we still have a significant amount of investors that invest with their self-directed IRA. Oftentimes, too, we have investors that start investing with us traditionally, and then they might have too much money tied up in other deals. They don't have access to it. So then they turn to their IRA and then invest with the SDR IRA instead.
So Ashley, I just want to add something here. I do have investors who invest through self-directed IRA, but also a lot of them go through what's called a solo 401k. I don't know how many of you here are aware of it, but if you have any kind of small business, which is a single owner business, like a solo owner business, or you and your wife or spouse, you can set up a solo 401k. That's probably one of the best vehicles that I have seen where you don't have to deal with UBIT and still invest, get you that exposure to invest into real estate through it, right? The way I look at pros and cons of IRA or any kind of retirement account versus direct investing is that with retirement accounts, you already don't have liquidity. So I really like the fact that, hey, real estate and retirement to me is a good marriage because there's no liquidity anyway in a retirement account. Like, what do you do with liquid cash in a retirement account, right? It's sort of useless. You can't really tap in until you're retired. So it's perfect to lock it into real estate. For me, that just works. So personally, when I moved jobs, I rolled over my entire 401k from my employer into a solo 401k, which I could self-manage and invest. So I didn't have to worry about UBIT, right? And I invested 100% of in real estate. I'm not endorsing that you do, but I was like, I'm all into this, right? I'm all into real estate. So, I mean, I had played in the stock market, I had done options, I had done it all. So I was just happy to be in a place where I wasn't checking my, my bottom line every 2 seconds and seeing it drop down to 50% of its value, which I saw in 2008. So it was kind of nice. But that said, I think there are some cons, like Ashley pointed out, with using specifically self-directed IRAs, but that can be overcome if you are eligible to set up a solo 401k or what's called a QRP, which is a qualified retirement plan. So there are some other options there, and I have written some blogs on the subject. If you guys want to go visit my website, Cherry Street Investments. The cons, I would say, of investing in retirement account is that you don't really benefit from depreciation. I would call that the biggest con. So when I see a great depreciation and I'm like, I'm not going to be able to use it, right? You can't use the depreciation in a retirement account against offsetting income because you are not paying taxes in a retirement account, right? Not when it's growing. Even in a Roth IRA, you still can't use it. So that's for me the biggest con of investing into retirement. I mean, into real estate using retirement is that you don't benefit from depreciation.
Yeah, I know. I mean, it really comes down to why you're investing, which everyone's case, it's case by case. If you don't need the depreciation, then, which is the case for some of our investors, and right. I'm sure for yours, they overlook it. They don't care because they have so much depreciation. Maybe they're carrying forward, then they don't have that exposure. So they're willing to stomach that. And then they might not have any other options that they feel comfortable investing in. One thing I can say, and I'm sure it's the same thing with your investors, Kavitha, is our repeat investor pool is very high, very, very high. So in terms of, it doesn't always coincide with timing of when someone has capital to deploy. So they might have to turn to their, self-directed IRA or QRP, or, it really depends on the, it really depends on the situation. We can talk about all these hypotheticals in terms of what the masses do, but one thing that I heard on our podcast the other day that we were recording that was something really interesting. It was the first time I heard this, is that there is a gentleman who most people find an asset that they want to invest in first, and they become an active investor, and then they market for capital that matches that asset. But this gentleman that we were talking to, he is a friend who does the opposite. He looks for capital first. He finds capital. And then once he finds capital, he figures out, okay, that capital would be best to find a home here. and then he matches the asset class as opposed to matching the investor. So it's kind of, you know, a switch, but it goes to show you there's a lot of different ways that you can execute and continue to grow your wealth and create financial freedom. So
yeah, I mean, I do some of that in the sense that, for example, let's say I'm investing into land. I'm looking for like high equity growth, right? Like I want to grow my capital quickly, but it doesn't give me depreciation when I invest in land. So I'm thinking, I'm going to use my retirement account there because one, it can grow. I don't need money anyway. But two, there's no depreciation. I'd rather not invest my cash into that because I want to keep my cash and collect depreciation, right? Exactly. So I kind of go like, okay, the retirement accounts usually high growth, high equity growth, don't care about depreciation kind of assets. And then that's my personal strategy. So everybody has to kind of decide for themselves, okay, which is like you said, what is the capital and what's the best and highest use of that capital? And in terms of both taxes, tax benefit, as well as growth.
Exactly. I couldn't agree with you more. And that's how we structure it too. And that's, I think, probably the most competitive way to just structure it, because that's the way you're able to grow collectively across your entire, you know, your net worth. The strongest and the fastest is matching certain capital up with certain investments. So,
right. Another pro I was thinking, it crossed my mind, of retirement accounts is that the compounding effect is much higher because you're not worried about paying taxes, right? So when an investment goes full cycle and returns back to your retirement account, you can deploy all of it, versus in a traditional cash setting, you still have taxation at the end of that investment, right? So it kind of dilutes your dollar and you don't have the entire amount to go back and invest with. So your compounding effect is actually enhanced in a retirement account versus a non-retirement setting.
And the only caveat is if you do a 1031 or you do another, if you do a 1031 or you do, you're able to structure another investment. I mean, you can also do an OZ and do the step down basis, but then the third way is if you continue to invest in opportunities that have huge cost segs, because you can just roll your investment into another investment. As long as it has a huge cost seg, then your gains from the previous investment will be offset on a future. So
definitely consult your tax advisors on these strategies. But generally, like passive income, passive losses, if you can create passive losses in the same calendar year with the new investment, then it'll offset that passive income that you created in the previous investment.
It also too rolls forward. So it's not use it or lose it. So if you don't use up all of your passive loss in a calendar year, it rolls forward. We have a significant amount of roll forward on our previous years. And it's not just 1 year, it's actually a couple years now that we haven't used up all of it. So now we have a bunch to offset. So there's different ways in which you can build. But the one thing I would have to say though, it is so important. If I was just starting out and someone said to me, your tax accountant matters and it's worth paying doesn't mean you have to pay the most, it doesn't mean you have to be price gouge, but if you're either A, doing your own taxes and you're not a tax accountant, or B, you're paying the minimal amount, I can tell you that it will be more difficult, most likely it'll be more difficult to come up with a very good strategy that fits for you perfectly. There's a reason why, even though, my husband and I know all of this stuff and all these different strategies, most of these strategies we've learned and confirmed through our real estate focused CPA. And the reason why I pitch a real estate focused CPA, because some people, they talk to me and they say, well, I have a financial advisor. Well, financial advisors, there's two different types of financial advisors. So there's financial advisors who are giving you financial advice just financial advice and you pay them and it's set fee. But then there are financial advisors who give you advice because they get compensated when you invest in certain asset classes. And that's the large majority of financial advisors. So without knowing what financial advisor you're tapped into already, I just blanket recommend someone who is focused in a real estate focused CPA. Now, oil and gas or the energy sector could also be another. If you have a CPA that's focused in that asset class, I'd highly recommend that. And the reason why I recommend this is because, and I always give this analogy, the first time I played Monopoly, I thought that the object of the game was to get around the board as fast as possible and buy as many properties as fast as possible. And what I quickly realized after playing the game is that certain properties had more value than other properties. And if I spent my money on the purple and the orange and the pink and the yellow properties, I would run out of money for the green and the blue properties. So the properties that are on the Boardwalk and Park Place side, and Boardwalk and Park Place are the blue properties, right? So what I realized after learning the rules to Monopoly is it's not getting as many properties as you can. It's getting houses and hotels up as fast as possible on the right properties. If I had known those rules when I first played Monopoly, the first time I played, I would have had a higher probability of success at playing that game. To me, the tax code is the rule of life. Those are the rules that make people a lot of money. And the people who know those rules, because they're very complex, they're very, it's crazy. Even CPAs are like, oh, we have to wait for clarification because no one understands. Even the IRS didn't understand how to define what's going on here. Those folks who are highly specialized are the ones you want to rely on. Just like if you need orthoscopic surgery on your knee, you go to an orthopedist who, you want the best. So you should also want that too, because this is your future. And having a tax strategy meeting once a year is really, really important. And I'm telling you, it's a drop in the ocean compared to the wealth you can build if you assimilate to the right and associate and identify the right CPA for you. So that's the one thing if you take anything from what we've just talked about for about an hour here, that is the most important thing that you could take from this entire conversation, is making sure, and it's actionable. That's something you can do tomorrow. You can literally get references. You can go on Bigger Pockets, look for recommendations of CPAs that people are referring. You can go on LinkedIn, you can ask around to other real estate investors who they recommend, but that is the most important thing that you could possibly do.
Couldn't agree more. I always say, they say a penny saved is a penny earned. I say a penny not paid to Uncle Sam is a penny earned.
That is so true. I love that. I'm gonna borrow that, but I'll give you credit every time. Don't worry.
Okay.
So last but not least, I think we might be running up on time here.
We lost track of time there. Okay, but as long as people are hanging out, listening, it's cool.
The last thing I just wanted to leave you all with is, why do I invest in other passive investment opportunities? I have my own, apartment syndication firm. I could just plug all of my money into that. Well, it would be really hypocritical of me to have just told you for about an hour and a half now why you should be diversified and not take my own advice. So we often get calls, and it's part of the reason why I don't specialize in capital raising, because when we get calls and someone says, Ashley, I have $1 million to invest and I only want to invest it with you, which we've gotten on several occasions. This isn't a hypothetical story. I spend the next 15 minutes telling that individual why that is the worst decision they could possibly do, that they should be diversified. Now, frankly, it would benefit me if they invested $1 million with me. It's easier if we have fewer investors. It's easier for our raise. It's easier for management. It's easier for our overhead costs for doing tax prep and distributions, all of those things. But it's not doing a good service to that investor. And I would not be doing a good service to myself if I don't take the advice that I'm telling everyone else to do. So it is really important, just as I'm telling you, for me to look at different markets, different asset classes, different operators, and figure out a way to be balanced across our entire portfolio, our family portfolio, to build generational wealth. That is my goal. That is my husband and I's strategy, is we are building generational wealth for our family. And the best way to do that is through diversification. So short answer compared to the other topics we were going to talk about, but I want to make sure that I open up for a few questions if anyone was waiting to the end to ask a question. So thank you so much, Kavitha, for having me on tonight. Hopefully there was some good nuggets in there for everyone.
Awesome. A lot of nuggets here. I hope you guys got something out of this. And I know someone's asking for Ashley's information. I'm just going to put her email in the contact information and also her website. It's ashley@bardowninvestments.com, but I'll just paste it in the chat, in the Q&A box, see if that works.
And you can sign up. We have a newsletter you can sign up for at bardowninvestments.com. Jay puts out a lot of content in general, but he puts out private content on our Bar Down Investments, where he talks about all different types of things, everywhere from market economics to things within the multifamily sector, to the economy in general. He is very, very smart.
I loved it. He actually made some postings on social media. I'm like, Jay, you're totally coming to my webinar and talking about all this, because we all understand so little of how everything is interconnected, and he explains it so beautifully. And I'm like, yeah, I just needed to hear this. So hopefully, I'm hoping to have him on soon. I spoke to him already, so yeah.
Yeah, he's incredible.
I think
definitely incredible.
One question: what's your preference in investing into a fund versus investing into a single asset?
That is a great question. I can see the benefit of both. So it also, I don't want to say this to offend anyone, but this is my personal preference. I think there's a difference in funds when they're an open fund versus a closed fund. So I personally prefer closed funds and individual investments over open funds. So for anyone who doesn't know the difference between an open fund and a closed fund, an open fund is a rolling fund that continues to bring assets into the fund, even while investors are already in the fund. So as an investor, you don't know what assets are going to come into the fund. Typically, there is a certain profile of an asset that might come in, but that is not 100% certain. Where a closed fund, the investments are already identified, and you can vet the assets that you're investing in. I like the idea of a fund because it provides diversification in it of itself to a level. You're typically still under the same operator, not all the time. Sometimes there are funds that are set up, equity funds, where an equity group identifies different operators. I think that's really cool. I also think too, it's really cool when it's different markets. And that provides diversification. I think that's amazing, especially if you have invested with this equity group before and you have faith in their vetting capabilities too, to identify good operators and good opportunities on your behalf. I think that's really, that is awesome. The open fund, the only reason I really don't like the open fund, and it's just the risk of assets being brought into the fund that don't 100% meet the criteria, but are kind of forced into the fund because they need additional assets. What happens when too much capital is raised, but there's not enough assets to support the payout structure? I think perhaps, an asset class might be thrown in that doesn't really fit the mold. And it puts someone in kind of like a precarious situation where they have to do it. Also, too, I think you can get into a slippery slope if it's the same operator where the funds are commingled in terms of the operations and CapEx budgeting, et cetera. So you just have to be really careful on how the funds are structured. But I do like funds personally. I think it provides diversification in and of itself. But I also like individual assets because, there's more certainty in terms of all the pieces to the puzzle. So I think there's benefits to both and cons to both. You just, why not do both, really? Like,
diversification.
Diversification at its best right there.
Awesome. Thank you so much, Ashley. Thank you all for joining. I hope this was, you got some nuggets out of this, and webinar will be posted on YouTube. So you can go rewatch this if you feel like you missed something out. Ashley, thank you so much for your time and sharing all the wealth of knowledge that you have accumulated with our audience here today, and also the audience on YouTube who will watch this recording. I also live stream this on YouTube, on Facebook, actually, part of it anyway. So thank you again.
Thank you again. And if you want to follow me, you can follow me at Bad Ash Investor on Instagram.
She's totally badass. Awesome. Thank you so much. Have a good night, everyone.
Thank you. You too. All right. Bye.
Hi, I'm Kavita Bartake. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.